Bitcoin has experienced a significant sell-off, dropping over 5% in just hours. This downturn has sent shockwaves through the entire cryptocurrency market. Here's what happened and what it could mean for the future of crypto investments. As we look ahead, the immediate focus for traders will be whether Bitcoin can stabilize after this weekend's drop or if it will continue to decline under ongoing macro concerns. Bitcoin, often seen as the bellwether for the entire cryptocurrency market, experienced a significant downturn, prompting questions about the sustainability of its recent rally. This decline is largely attributed to macroeconomic pressures, including rising interest rates and inflationary fears, which have historically affected risk assets. The Federal Reserve's stance on monetary policy is particularly influential, as traders weigh the implications of potential rate hikes on liquidity and investment sentiment. There are several potential scenarios to consider. If Bitcoin fails to recover quickly, we might witness further underperformance in altcoins, as the market tends to treat Bitcoin as the primary risk benchmark. This could lead to a cascading effect where traders liquidate positions across the board, exacerbating market volatility. Conversely, if Bitcoin manages to stabilize and reclaim its lost ground, it could restore confidence in the market, potentially leading to a rebound in altcoins, which often follow Bitcoin's lead. Experts suggest that the next few days will be crucial in determining the trajectory of the cryptocurrency market. Traders will closely monitor global rate expectations and macroeconomic headlines that may influence risk assets. The outcome of these developments will likely shape investor sentiment and trading strategies. In this volatile environment, one particular question looms large. How will Bitcoin's performance impact the broader sentiment towards cryptocurrencies in the face of tightening financial conditions? As traders navigate this uncertainty, the focus will be on Bitcoin's ability to maintain its position as a market leader, influencing the future landscape of digital currencies. The upcoming week will be pivotal for establishing a clear market direction. The recent sell-off in the cryptocurrency market did not occur in isolation. It is the culmination of a complex interplay of events leading up to today. Over the past several weeks, the cryptocurrency market faced mounting pressure from various macroeconomic factors. Rising interest rates have created a challenging environment for risk assets, as higher borrowing costs typically deter investment. Additionally, central banks worldwide have adopted increasingly aggressive monetary policies to combat inflation, further contributing to market unease. Heightened geopolitical tensions, particularly surrounding energy prices and international trade, have added to the sense of uncertainty. The launch of CME Bitcoin futures has intensified selling pressure, reflecting a broader risk-off sentiment among investors seeking safer havens. This was exacerbated by hawkish comments from the Bank of Japan, signaling a potential shift towards tighter financial conditions, a scenario that historically triggers negative reactions in the crypto space. Bitcoin's vulnerability is particularly noteworthy, as it has previously exhibited a strong correlation with traditional market movements, reinforcing its classification as a risk asset. Past downturns in the cryptocurrency market were often linked to regulatory crackdowns or technological failures within the ecosystem. However, the current situation highlights a pivotal shift. The market's fragility is now largely influenced by external economic conditions, especially the actions of major central banks. As a result, traders and investors are grappling with the need to reassess their strategies. The impact of this downturn is profound, as it not only diminishes investor confidence, but also raises questions about the long-term viability of cryptocurrencies as an asset class. Looking ahead, the landscape will likely remain volatile as investors adapt to an environment increasingly dictated by macroeconomic indicators. With central banks expected to continue shaping market dynamics, strategic foresight will be essential for those navigating this evolving financial terrain. The recent sell-off in the cryptocurrency market is particularly significant for investors, as Bitcoin continues to act as the cornerstone of this digital financial landscape. When Bitcoin experiences a sharp decline, it typically exerts downward pressure on the prices of other cryptocurrencies, a trend that was clearly evident in today's market reaction. The CoinDesk 20 Index, which tracks a diverse basket of the largest cryptocurrencies, also registered a notable downturn, underscoring the interlinked nature of these digital assets. This sell-off is more than just a fleeting market fluctuation. It represents a broader trend that has been influenced by various macroeconomic factors. The context of this decline is rooted in a confluence of external pressures. Central bank policies, particularly interest rate decisions and inflation concerns, have created a climate of uncertainty that permeates financial markets. As traditional investors reassess their portfolios in light of these economic indicators, cryptocurrencies, which are often seen as high-risk assets, become the first to feel the effects. Traders are now approaching the market with heightened caution, vigilantly testing critical support levels that could dictate the future trajectory of Bitcoin and its counterparts. The immediate consequences of this downturn are already apparent. If Bitcoin fails to regain its lost value swiftly, it could trigger further de-risking among traders, especially concerning altcoins, which tend to be more volatile. This broader sell-off illustrates that the sentiment driving the market is not solely based on internal crypto developments, but is heavily influenced by external economic conditions. Investors should be particularly vigilant, as this situation serves as a stark reminder of how susceptible cryptocurrencies are to fluctuations in traditional finance. The average person should take note of these dynamics, as they illuminate the inherent volatility of cryptocurrencies and their close ties to mainstream financial markets. The health of Bitcoin is crucial, as it directly influences the performance of other digital assets. Looking ahead, the ability of Bitcoin to stabilize in the face of these economic challenges will be critical not only for investor confidence, but also for the broader adoption and future of blockchain technologies. As the market navigates these turbulent waters, the next few weeks will be pivotal for the cryptocurrency ecosystem. On July 27, 2026, Bitcoin experienced a dramatic sell-off, plummeting approximately 5.7% shortly after the opening of the CME Bitcoin futures market. This sharp decline sent shockwaves through the entire cryptocurrency sector, triggering a broader downturn across major cryptocurrencies. The price drop was primarily attributed to a hawkish shift in monetary policy from the Bank of Japan, which sent ripples across global financial markets. The downturn began at around 9:30 a.m. local time in Tokyo when the Bank of Japan signaled a potential tightening of financial conditions, a move that caught many investors off guard. Bitcoin, often regarded as the bellwether for the cryptocurrency market, fell from approximately $30,000 to just below $28,000 within a few hours, raising concerns among traders and analysts alike. This decline was not isolated. The CoinDesk 20 index, which tracks the performance of the largest cryptocurrencies, mirrored this downward trend, indicating a widespread market sell-off. What sets this event apart from previous sell-offs is the macroeconomic influence of central bank policies rather than solely internal crypto market dynamics. Typically, significant movements in Bitcoin's price can either be fueled by market sentiment or specific events within the cryptocurrency space. However, this time, external economic factors played a crucial role in triggering the sell-off. The impact of this event extends beyond immediate price fluctuations. Investors are now grappling with the implications of tighter monetary policies, which could signal a shift in the risk appetite for cryptocurrencies, traditionally seen as high-risk assets. The intertwining of traditional financial markets and the crypto sector suggests that Bitcoin and its counterparts may increasingly react to global economic signals. As central banks worldwide navigate inflationary pressures, cryptocurrencies could face heightened volatility as investors reassess their portfolios. Looking ahead, the cryptocurrency market must brace for continued uncertainty as central banks reconsider their strategies. The influence of macroeconomic indicators on Bitcoin's price may lead to more cautious trading strategies among investors. As we move forward, the focus will be on how Bitcoin responds to potential changes in monetary policy and whether it can regain its footing amidst evolving economic landscapes, particularly if the Bank of Japan follows through with its tightening measures. What will Bitcoin's performance mean for the future of cryptocurrency trading? Share your predictions in the comments below, And don't forget to subscribe for daily deep dives into the biggest stories shaping our world.